So welcome to the next lecture of public finance. In the next lecture we are going to discuss the fiscal federalism. So federalism under polity means we have a union government and we have a state government. Fiscal federalism means the features of the federalism which are related to the fisc, which are related to the center state finance relations, we can say in simple words. So under this center state finance relation or under the fiscal federalism, we are going to cover the following topics. It's like constitutional articles, relevant constitutional articles which are related to federalism. Then we'll discuss the central sponsored schemes, and we will also discuss the Gadgil-Mukherjee formula, the special category states, why states like Bihar, Odisha, they are demanding the special category states, what extra benefits the states will get if they will be covered under special category states, how it was started and all. So first of all, I'll start the constitutional articles. First article that we are going to discuss is Article 265. Article 265 says that tax can be levied only by the authority of law, or we can say no taxation without representation. So we can say tax can only be levied by the authority of law. This is what we have, Article 265. Then we have Article 266 and 267. Both these articles we already discussed in the budget. 266 we have is Consolidated Fund of India plus the Public Account Fund of India. We discussed CFI comes under the Parliament or the legislature, and the Public Account Fund that comes under the present executive. Then 267 is Contingency Fund of India. So that Contingency Fund of India, which is under President and being maintained by Finance Secretary. So that Contingency Fund of India of 500 crore is being maintained by the President for contingency situations. So these three articles we already discussed. Then we have Article 268. This article we also discussed in the last class. So under 268, some taxes will be levied by union but collected and appropriated or used by the states. And we also discussed two examples of Article 268. One was that other excise duties. It means excise duties on toilet and medical preparations like liquor, opium, etc. And then other stamp duties. Then we have Article 268A. 268A is related to service tax. We discussed service tax came in 1994 as the power of residuary power which resides with the union government. That started in 1994. It was started from three services only: telecommunication, insurance and share market, and then it was extended. Now we have a negative list concept. Except 17 items, service tax is applicable on each and every service. Next article is Article 269, under which tax will be levied and collected by union. Here at the first stage it is only being levied. At the second stage it is levied and collected by union but used or appropriated by the states. Here also we discuss the 2-3 examples like taxes on sale and purchase of newspapers and advertisements. Then we discuss the central sales tax. All these comes under Article 269. And then we have Article 270. So earlier means before 10th Finance Commission. Finance Commission we'll discuss in next lecture. So before 10th Finance Commission, the fiscal federalism structure was different. The structure was like, at that time there were central taxes and then there were shareable taxes, and then we have state taxes, and then we have 268 article and 269 article. So this was the structure before 10th Finance Commission recommendations. It means before 2000. So the recommendations, they were implemented by 11th Finance Commission. So these, under this, the shareable taxes, only these taxes were shared between union and the state on the recommendation of finance commission. So under this there were only two taxes. First tax was private income tax. So earlier PIT was a part of 270 and second one was excise duty. But on the recommendations of the 10th Finance Commission, these two things, they were merged and this full pool was made shared on the recommendations of 10th Finance Commission. But before 10th Finance Commission, only these two taxes they were shared. It means PIT will be shared between union government and state government. Excise duty will be shared between union government and state government on the recommendations of the Finance Commission. But after this 10th Finance Commission, the central taxes, which includes corporate income tax, stamp duty on financial institutions, customs, all this they will become the central pool of taxes, and this full central pool of taxes will be shared on the recommendations of the future Finance Commission. So after 11th, 12th, 13th and 14th, this is the new pattern. So earlier under 270, what is there in 270? The shareable taxes, or we can say the central pool of taxes. So earlier there was only PIT was there in 270 and 271 is surcharge. We discussed nowhere in the constitution as such cess is mentioned, but surcharge is mentioned in article 271, then article 272. So 272 now it has been repealed. Earlier excise duty was mentioned. Earlier the scenario was that personal income tax was mandatorily being shared between union and state, and excise duty, if passed by the parliament, if parliament allows that excise duty should be shared, then only excise duty will be shared. This was mentioned in the constitution, but now because we have created a central pool of taxes which includes excise duty, corporate income tax, personal income tax, service tax, so now this article 272 has been repealed. Then next relevant article is 275. 275 is nothing but the grants on the recommendations of Finance Commission. So under Finance Commission we will discuss that before 14 Finance Commission, the Finance Commission were giving 5 types of grants. These 5 types of grants were for the post devolution if there was some deficit, so that was being compensated by the Finance Commission. Then afterwards there was some grants given to the local bodies, then there were some grants given to that for disaster management, then for sector specific and state specific grants. So these 5 types of grants were given before 14th Finance Commission, but 14th Finance Commission removed last 2. It means sector specific and state specific. So grants given by Finance Commission means to compensate that your revenue deficit, grants given in detail we will discuss in 14th Finance Commission. Then to local bodies, and then for disaster management. Just for the information I am giving you some values. This revenue deficit is 1.91 lakh crore. So over the next 5 years, it means 2015 to 2020, 1.91 lakh crore will be devolved to this local bodies is 2.87 lakh crores, and for disaster management they gave 55,000 crores. We will discuss again in 14th Finance Commission. So these are the grants given by Finance Commissions. Now these grants given by Finance Commissions, they are charged. They are charged on the Consolidated Fund of India. It means there will only be voting on this, but there will not be any there will only be discussion on this charge expenditure, but there will not be any voting on this grants given by Finance Commission. In that budget we discussed that in the budget making process that appropriation bill is the addition of demand for grants and charge expenditure like the salary of president and all. So the grants given by Finance Commission, it also becomes a part of the charged expenditure. Then we'll discuss 276. So what is there in 276 is professional tax. We discussed professional tax are being levied by the states. Earlier it was 2,500 rupees. 14 Finance Commission recommended to make it 12,000 rupees. Then we have is 279. 279 is net proceeds of taxes. Net proceeds of taxes means, suppose this is union government and union government is collecting suppose 15 lakh crore as tax, which includes PIT, CIT and all. Now on the recommendations of the Finance Commission, some amount of tax will be devolved. For example, they are saying 42% of X. Now this X is net proceeds of taxes. This X is not equal to 15 lakh crore, because when the union government is collecting 15 lakh crore, there is some administrative cost which is attached to this collection. Union government has to recruit income tax officers and all, they have to set up this office. So whatever the administrative cost that will be attached, that will be subtracted from the tax collection, and 42% of net proceeds of taxes will be shared by union government with the state government. Now there should be some constitutional bodies which should find out the value of this net proceeds of taxes, because otherwise the union government wants the administrative cost should be very high and the states wants the administrative cost should be very less. So the value of the administrative cost or the value of this net proceeds of taxes is being decided by the constitutional body, that is known as Comptroller and Auditor General of India, CAG. So CAG is going to decide what is the value of the net proceeds of taxes, or what should be the value of this administrative cost that is attached for the collection of the taxes. So this is what we have, Article 279. Then we have Article 280, which is nothing but Finance Commission. Then we have 281, it is nothing but the recommendations of Finance Commission. After this, we have few more articles, that is 282. 282 is again grants or the discretionary grants or non-statutory grants given by union government. In simple words, we can say grants given by erstwhile Planning Commission. So union government was giving grants or discretionary grants under Article 282. Then we have Article 286, 289, 292 and 293. That's it. 286 is union property cannot be taxed by the states. It means suppose there is some big property or big building or office of ONGC. So that cannot be taxed by the state government. That property tax cannot be levied. Suppose there is some parliament is there in Delhi. So Delhi government cannot levy any tax on the parliament. Then we have, or the building of the parliament. Then we have 289 is just vice versa, state government. The property of the state government tax cannot be levied by the union government. Then we have 292, which says the borrowings of the union government, and 293 is borrowings of the state government. But we already discussed, but states cannot borrow from outside India unless and until they take permission from the union government, because whenever you are borrowing from outside India, the mortgage is the consolidated fund of India, which comes under union government. So whenever states wants to borrow from outside India, they have to take permission of the union government. That is what we have, Article 293. So all these articles are related to fiscal federalism or center state finance relations. Again, I am giving you 30 seconds to revise all these articles. Afterwards, we will discuss again. So, Let's revise these articles. First one is Article 265, which is tax can be levied only by the authority of law. Then we have Article 266, Consolidated Fund of India and Public Account Fund of India. Then we have 267, which is Contingency Fund of India. Then we have Article 268, which is tax which is levied by union government but collected and appropriated by the states. Then we have Article 268A, which is service tax. 269, taxes which are levied and collected by union government but appropriated by the state government. 270, central pool of taxes, and from this central pool only taxes will be devolved to the states. 271 is surcharge. 272 is abolished. 275 is grants on the recommendations of Finance Commission, and these grants are charged on the Consolidated Fund of India. Then we have 276, which is professional tax. 279, that is net proceeds of taxes. 280, Finance Commission. 281, recommendations of Finance Commission. 282 is the discretionary grants given by union government, and Planning Commission was given grants on the basis of this thing. 286, union property cannot be taxed by states. 289, states property cannot be taxed by union government. 292, borrowings of the union government. 293 is the borrowings of the state government. So this first topic